What's up, everyone? Welcome to the daily macro update for Monday, September 15th. Taking a look at the manufacturing data from today, we received the New York Fed Manufacturing Index for September, which showed a 1-month decline. And so the reason why we like to pay attention to the New York Fed Manufacturing Index is because it's one of the leading economic indicators, not only for manufacturing, but it's also a leading economic indicator for the general economy as well. And so looking over the past 3.5 years here, as you can see, the manufacturing sector has remained in recession for pretty much the last 3 years, right? Um, and so we haven't necessarily seen an aggregate recession, although in some cases you could make an argument for that, depending on which cohort of the income and asset holding level you are. But just taking a look at this, as you can see, I mean, really there hasn't been any type of recovery in the manufacturing sector at all. And this combined with the weakening labor market is what is causing a lot of still support for Fed rate cuts happening this Wednesday. This Wednesday is the September Fed meeting, and the Fed is expected to cut rates by at least 25 basis points. Taking a look at the target rate probabilities for this Wednesday at the recording of this video, right now it's over a 96% chance that they're going to cut by 25 basis points. And whether you agree with the Fed or not, they are cutting interest rates into rising inflation. And when the Fed is doing that, it's the reason why you have gold surging. It's the reason why you have the S&P 500 continuing to make new all-time highs. It's the reason why you're seeing small cap stocks perform the best, outcompeting the mega cap tech stocks. And then also, two, when just boiling it down to the ratio between discretionary versus staples, right? This is one of my team's favorite ratios to look at here. As you can see, this made new highs from the high back in late January of this year. And so when this is in a bullish trend, and right now it's actually been accelerating, this is a clear sign of a risk on environment. So for those people who are trying to short this market right now, thinking that it's topping out, I would not do that at all. Of course, that's not financial advice, but according to our process, if something is in a very clear bullish trend, you do not want to try and be a hero and time the top and short it just because it's up a lot, or somebody on YouTube or on the news says, hey, things are overbought, right? So what you want to do is still be able to enact proper risk management strategies, as well as just respect the trend, because in this post-pandemic environment, especially with the flood of liquidity that's still swimming throughout the market right now from the $4 trillion that was added to the Fed's balance sheet because of the global shutdown, that has not been fleshed out at all, although the rate of change of that is slowing, and you have the government essentially making up for it by printing treasuries. If a slowdown comes, the market is actually happy about it because it's going to just bring a lot of money back into the United States. And so, a lot of people are confused. Hey, I thought that if the economy isn't doing well, then, the stock market should reflect that. Well, not necessarily. And in this environment where, everybody is hyper fixated on the stock market participation is way higher than it was 20 years ago with the onset of apps like Robinhood, as well as some of the more legacy type of brokers like Charles Schwab, Fidelity. They all have their mobile apps so that you can, retail can essentially see what's going on. Stock market participation is through the roof these days. And so in this type of environment, you have more front running than usual. That in combination with the majority of the flows in the market are being, as a result of the large amount of passive investing that's going on. It's just a recipe for this market to continue to go up, even though we have more signals, for a contraction or a slowing economy, right? The market is effectively front running even more liquidity coming into the markets, and that's what you're seeing right here. Now, at some point, I do think that it will realize that things are slowing down, and maybe we'll have some type of correction. But I'm not going to try and predict when, if, or what magnitude that's going to happen, because there's really no point in trying to do that, because your main goal should be to remain in the bullish trends that are continuing to perform well, instead of trying to predict or time these reversals, because the market typically just goes up. You don't want to try and time these things, okay? Just play with the hand that we're dealt, and just don't try and fight the trend. Let the price charts tell you the story. All right. That's probably the best advice that I could give based off of personal experience, as well as what's in line with my team and I's model. Now, with that being said, you are seeing the 10-year U.S. government bond yield breaking down this trend here, right? And so for really the past 8 months or 9 months, we've been talking about this stagflationary ping pong that the 10-year U.S. government bond yield has been doing, since November of last year, where, you would have inflation expectations rising, you would have the long end of the curve rise up to around 4.5%, and then either recessionary fears or something else would cause it to come back down. And then we were just having this bounce for about 9 months. You did have a brief dip below this range back during the April crash, and then it had a quick rebound from there. And now we're seeing a more sustained breakthrough of that 4.2% level, which, again, something that we've been talking about is what's either going to break this is that you're going to have a slowdown in the economy, or you're going to have just inflation get out of control. And even though inflation is still rising in the short term, what the market is essentially pricing in is that things will reverse, after these next couple months, right? So around November data, which gets reported in December, that's what the market is currently pricing in for it to start to see, actual slowdowns in inflation. But when you take a look at things like the 5-year break-even inflation rate, you can see that from this time last year, right? So around mid-September of last year, this was around 1.9%. And now, a whole year later, it's about 50 basis points higher than that, meaning that long-term inflation expectations are going to remain elevated. And so if this remains, high like this, then there will be a cap on how low the Fed can go with their rate cuts, right? Even if they cut by 100 basis points, right, that brings it down to like 3.5% for the Fed funds. That's still way higher than what the average Fed funds rate was over the past 15 years. And so you're still going to have a net higher than average interest rate compared to the last decade and a half, as well as potentially higher inflation. So, we'll see what happens. It won't be the crazy amount of inflation that we saw back in 2022 with it going up to 9%. I think that type of inflation is not coming back anytime soon. But I think in this post-pandemic environment with the flood of liquidity that's out there, as well as a very tight labor market, as well as this deglobalization trend going on, you're going to have structural supply side changes that's going to just keep inflation elevated in the long term. And so, yeah, I think that's going to be the new norm. Not saying that's bad. It's just, not the same environment that we were in pre-pandemic. And so for those people and economists, and as well as people who think that we're just going to go back to that pre-pandemic environment, that doesn't look like that's happening anytime soon. And so with that being said, my team and I, we're still going to remain bullish assets, but in the immediate term, especially heading into this Fed meeting on Wednesday, we've been taking profit on a lot of the different assets that have been performing well over the past several weeks, over the past couple months, really. And so, yeah, I mean, lots of Mag 7. I mean, we see Tesla right now having we saw Tesla have a large breakout here this morning, as well as the past couple days. Our model has been long Tesla for, pretty much the last month and a half, almost 2 months now. And so, yeah, it's great to have a reliable, unbiased process that gets you into these things, before they start to go vertical. But hopefully you have a process that's like that. If you guys don't, then I would highly recommend checking out our website so that you can get started with that. Our entire training is online. It's just a one-time price of $27. You get all 10 hours. You can pretty much learn everything that I know and my team knows within a weekend, right? So that'll give you a huge jump start. But yeah, I mean, we're just seeing a lot of risk on plays do well, and even if we have a little bit of a pullback here in the near term, in the next couple weeks, that'll just be another opportunity to buy the dip, as long as we continue doing what we're doing right here. And so, with that, I'll go ahead and turn it on over to any of the questions that we have here in the chat. One being, I'm going to start on YouTube with Matthew Wright. He's actually one of our members here. Welcome, Matthew. Appreciate you joining, sir. Let's see. Do you think we'll see a sell the news type of pullback after the meeting on this gold and S&P 500? Well, what you're asking me to do is predict what's going to happen in the immediate term, which there's no way of predicting that. What we can do is observe the setup heading into those. And, right now, the dollar is at the low end of the trading range. We have bond yields at the low end of the trading range, while at the same time, you have gold as well as S&P 500 at their top ends of the trading ranges. So if you get any type of, I guess right now, it would be peak dovishness being priced into the market. And so if you get anything other from Jerome Powell on the press conference speech, if you get anything other than incredibly super dovish, right? So if his tone is a little bit less dovish, then you could see a little bit of a correction from the two extremes that we're currently at right now, if that makes sense, right? Which again, that's not me saying, to go bearish on the market. As you guys know, who've been watching the channel, the bookshelf in the background has been green, meaning that we're bullish on the S&P 500. It's been like that. If you go back all the way at the end of May, it's been like that, right? So even if you were just tuning into these videos every single day during the week, and you were just looking at the bookshelf, and then you turned off the video after seeing what color it was, and you were staying invested in the S&P, well, you're up, over 9%. So, it's something where if we do have some type of short-term correction, I'm going to buy the heck out of the dips that continue to remain bullish, because again, I think the longer-term implications are that we're going to continue to see this go up. If silver and other metals are blowing up due to expected inflation, why isn't oil and natural gas? Well, I mean, those are two, separate commodities, right? The energy sector is a lot different from the precious metals sector. One has to do with input prices. Well, they both have to do with input prices, but they're two separate things on inflation, right? So I mean, in fact, if you have cheaper fuel prices, and that allows you to, mine, produce, or manufacture things from those base metals, then you could continue to see a higher demand of those base metals. So, it's not something, it's just two different things, right? And, if you take a look at the price of oil, yes, it is in bearish trend right now, but on a year-over-year rate of change, the comparisons are still weak. Heading into, let me see when this bottomed here in 2024. We didn't really see an acceleration in oil until let's see, like mid-December. So you could continue to see easy comparisons until then. Yeah, and then obviously so far in 2025, which means for the first half of 2026, it's going to be easier comparisons as well. What do you watch more, bond yields or prices? which one is your preference for to see divergence of bond and USD index, for example? Man, Samit Pawar, reading your question there hurt my brain a little bit, but I know what you're trying to say. And the answer is that I don't have a preference at all. I like to. It's like asking, a parent if they have preference over any one of their children. The answer is no. You love each child, um, you know, uh, with the same amount of love, right? Well, with what we look at in terms of equity prices or bond prices or currency prices, all of those have to be used in conjunction with each other in order to determine what the signals are being shown in the price charts, right? Um, Now, when you say yields or prices for bonds, you're still looking at the same thing, just two different sides of the coin, right? Because bonds and yields are inversely correlated. So if you're looking at yields go up, that means bond prices are going down and vice versa, right? So, on the same token, I could just say like bond prices are bullish right now, which would mean yields are bearish. So I don't really have a preference. You have to look at everything, right? All right, taking a look at some of the questions here from Instagram. Welcome, everyone. Let me take a look. XLY was a great catch. That Tesla run. Yep, consumer discretionary continues to remain very much in a bullish trend. Can you chat more about gold prices? Sure. I mean, did you have like any type of question with gold? It's something where it did provide a little bit of a relief. Let's zoom in here. Went sideways a little bit last week. You had an opportunity on September 11th in order to buy a little bit on that dip there. And then, today it's having a huge 105 basis point day. So, yeah, I mean, this move in gold is pretty much giving you a signal that, it's taking into consideration the Fed cutting rates and easing into inflation accelerating. So I wouldn't be surprised if this continues. Are you buying Ethereum here or waiting and watching? Ethereum, well, the answer to that is it depends if it's near the low end of the trading range. So let's take a look here. All right, so Ethereum is not near the low end of the trading range. And so the answer to my question would be no, I am not buying yet because I want to make sure that this is near the low end of the trading range and I'm able to take advantage of the most upside that I can. So yeah, that's your answer there. Let's just see what volume is doing. I do like how volume is coming down as well as volatility. So definitely good signs for Ethereum. Yeah. Some people in our group, when you take a look at the ranges, you might want to, or some people, buy down as on its way to the low end of the trading range. So some people might do that, but for me personally, I don't mind being patient there. But yeah, that's what I'm looking at. What's the sentiment like for Wednesday? Peak dovishness. Fairly valued or overvalued at this point. I don't look at if something is fairly valued or overvalued. If the market has a price, that is the fair value, right? So yeah. How are you positioning going into the Fed meeting? I'm just raising some cash heading into that. So a lot of the things that were bullish and that have been performing very well. One example of that would be Bitcoin miners. That's been one of the best performing asset classes this year in 2025. And so, yeah, I mean, since the April lows, this is up over 245%. So yeah, that one has been pretty good and it's gone straight vertical over the past week. That's something that I would be taking profit on in order to raise cash to buy lower. But yeah, Bitcoin miner stocks, man, They've just been ripping. All right, let's take a look at some of the questions here on TikTok, and then we'll go ahead and wrap it up. One second, just scrolling through. The text is small, so I got to squint my eyes. After the interest rate cut, will it be gas for the bull market? What's your opinion? I mean, the bull market's been going on, and it's already been pricing it in. So, yeah, I mean, the bull market has been a thing for quite some time over the past couple of years. So, do you think a reversal is coming post Fed cuts? We could possibly have a correction. You're asking for a short-term prediction, which I have no clue of deciding. Do you think we'll have 4 to 5 rate cuts in a row? I doubt it if inflation is, sticking up the way that it is. Do you think the main reason to keep market going up? No, they're not doing quantitative easing. They're just lowering rates. Gold is bullish. Do you find any correlation between Bitcoin miner going up and crypto lagging behind? I'm not sure what you mean there. Do you think we could be heading into a recession? Do you mean aggregate recession? Because again, when looking at the manufacturing sector, as well as looking at the bottom 50% of the country, there's definitely people who are in a recession right now, as well as industries that are in a recession right now. But if you're talking about an aggregate recession, it's really hard to tell. I mean, the most important chart that I've been looking at, besides the 10-year yield, is the rate of change of government spending. And as of right now, I mean, the government continues to just blow out deficit spending, and that's what's really propping up the markets. And if that has a slowdown, just like it did in March and April, then yeah, you could see a slowdown and a possible recession. But what you have to understand is that ever since the pandemic, the market is like a drug addict, right? And the government, as well as the central banks, all they're doing is upping the dosage every single time in order to keep the high going, right? But at some point, you get to a point where you kind of just max out and things start to tip over a little bit. And, we're currently not there at this point in time, but there will come a time where the government's going to have to back up with all of its deficit spending, right? That'll probably happen when rates start to come down a bit, and that, will probably happen, if we see a little bit more weakening, where it transitions from more of a government stimulus type of economy to going back to, a central bank stimulus type of economy. So we'll see, but yeah, I mean, it's a delicate situation, but at the same time, like, you don't want to just short the market because you're having fear of the potential risks that are out there. But yeah, for now, the music is playing, party on, but you definitely want to be aware once that reversal happens. Will we have a short-term top of the markets this week? No clue. What's your price target on silver? Having it go to 45 in the short term? I don't do price targets. I think they're completely worthless. All I do is I hold things that are in bullish trend, and once they stop their bullish trend, then I get rid of it. I don't know what price that could be at. It could be $40, it could be $90. I don't really care about price targets. All I really care about is, do I have exposure to that asset as it continues its bullish trend, right? It's kind of like, if you have your favorite, football team, do you really care what the score is at the end? Maybe you do if you're, betting on things, but, or do you really just care that your team wins? Right? That's kind of what what our thought process is. And anyone who's trying to, like, predict price targets based off of like Fibonacci or whatever, it's something where they're just guessing. It's really, it does not make sense to do price targets at all. Do you think it's a good time to dollar cost average? I don't dollar cost average, so I don't know. I do options trading, so I have to be precise. I mean, you don't even have to do price predictions with options trading, right? Because you can exercise a contract, if it's going the opposite direction on you. So, I mean, if you think that something is going to continue to go up, then, you can do a long duration call option, a year out and just, ride it as it goes up. You don't have to know exact price targets, right? So that strike price, it's not like you're trying to achieve that. You're just signaling that, hey, I think that the price is going to continue going up during this time frame. That's all that is. Thoughts on health companies? I mean, we are bullish on the healthcare sector. So, yeah. All right. Can you please take a look at silver? Any thoughts about it long term? I mean, if we just continue doing, if the current macro situation is staying, then silver will continue to perform well. I mean, the price of silver has been bullish, pretty much since June / May of this year. But over the long term, it's been steadily going up, right? Really, since March of 2024, it's been going up pretty steadily. So, yeah, I wouldn't be surprised if we continue with this trend. Is there anywhere that you're not bullish? Yeah, bearish on the US dollar. And then also, we're not bearish on it, but we're bearish on consumer staples. And then, yeah, bearish on consumer staples in the dollar. That's pretty much it. But yeah, we'll go ahead and wrap it up there. I appreciate everyone for joining. Again, if you guys need help trying to apply all this macro data so that you can stay ahead of these major market trend shifts, and if you want a lot of the morning call outs and actionable ideas, then I would highly recommend going to our website and submitting an application partnership circle or checking out our other programs there in order for you to get started. But appreciate it joining, and we will catch you in tomorrow's daily macro update. Bye, everyone.